Fund's objective is to deliver a combination of quarterly income and the potential for capital appreciation by investing in a diverse collection of the world's most resilient high-yield issuers over the long term. Our investment philosophy is that over the long term, bond prices follow the fundamentals of the companies that we invest in. So we spend our time researching the future prospects of individual company fundamentals, what we refer to as resilience, and no time is spent looking into fluctuating market sentiment. We construct the portfolio thinking first about the future resilience of our holdings. Resilience for us is a combination of a durable competitive position, a good approach to governance and sustainability, and an appropriate capital structure. We lend to around 70 issuers who we believe have a combination of these attributes. These issuers are diverse from 18 sectors in 20 countries. We size our positions to reflect the risks of lending to the underlying company and take no top-down restrictive views, duration positions, or currency exposures. So our performance is simply driven by the fundamentals of our holdings being reflected in valuations over the long term. Three aspects explain how our fund differs from our peers: our focus, time horizon, and conviction. Our focus is forward-looking and bottom-up first, expressing a view on individual company fundamentals. A traditional bond fund's focus is backward-looking and macro first, expressing various investment views. As a result, our holdings and portfolio look very different to our peers, typically resulting in us investing in more bonds of higher quality. Secondly, we have a longer investment horizon than our peers. We lend to a company for 3 to 5 years, when a traditional bond fund's investment horizon is usually about a year. This means we have much lower turnover, around 20 to 30% each year, avoiding unnecessary trading in what is a costly asset class. And finally, we invest with higher conviction than traditional high-yield managers, lending to around 70 issuers, 2/3 less than our peers. We believe the benefits are twofold. First, it limits the downside, potential for permanent loss of capital, as we know each resilient holding in exceptional detail and rapidly respond if it deteriorates. Second, it maximizes the limited upside offered by the asset class, as we hold large positions in highly resilient companies instead of managing risk by taking lots of small dilutive positions in companies that are just average. ESG integration at its core relies on considering how a broad set of issues affects a company's resilience. When we find potential issues, we do a deep dive stress test to get a sense of financial materiality. A recent example would be our review of our holding in biomass producer Enviva. Our analysis indicated that incoming regulation relating to wood sourcing, certification, and biodiversity could undermine the company's ability to procure enough wood to support its growth strategy. This led us to reduce our conviction in Enviva's resilience and longer term our position size in light of an additional risk we had uncovered through our ESG integration process. Following an in-depth review of existing positions earlier this year, we consider only around 15% of the portfolio to be severely affected by the social and economic implications of the pandemic. As you would expect, these are companies in the worst affected sectors, so leisure, autos, services, many of which have experienced 100% loss of sales for many months. To date, of around 70 holdings, we have only sold out of 3 positions due to weakened resilience. The only position we consider to be a default risk, Kadire at 0.3%, has recently secured a restructuring, so while technically considered a default by credit rating agency standards, it has so far not resulted in a loss of capital for our clients. While default rates within the asset class are already on the rise, we expect the fund will continue to outperform due to our focus on resilience, consistent with our track record, delivering around 60% fewer defaults than the market average over the fund's 18-year history. Confident in our existing positions, we have started investing in high-quality, attractive yielding, sustainable survivors. Some of our new holdings are in fact beneficiaries of the new environment, such as discount grocery and general merchandise store B&M, posting double-digit growth as people seek out value, or Pro Group, a niche German manufacturer of corrugated board, benefiting from surging e-commerce sales. We believe the fund is well positioned to deliver resilient long-term income, continuing its top quartile performance since inception.